Joining me now to talk everything markets related is Dean Smith, Chief Strategist at Folio Beyond and Portfolio Manager for the Folio Beyond Alternative Income and High Interest Rate Hedge ETF. It trades at the NYSE ARCA under the ticker symbol RISR. It is great to have you here. Dean, talk to me about what is jumping out to you as of late for very newsworthy markets.
Yeah, I mean, the chaos just keeps increasing, doesn't it? I mean, there's some people who had thought that with this 90-day pause in the tariffs that give people time to negotiate, things would settle down. But that's not what's happening, is it? We've got continuing chaos, announcements of 50% tariffs on steel and aluminum over the weekend. You've got now the U.S. and China trading accusations that they're backsliding on whatever deal is supposedly out there. You've got the EU, with whom the U.S. trades almost double the amount of volume that we trade with China. Bilateral trade between the U.S. and EU is twice that of U.S. and China. So we've got a long road to go here. And, the trade court ruling that came last week, that's just a bump in the road. They are not going to give up on this. This is their core economic policy.
Dean, are you in the camp right now that says at least since April 2nd, so-called Liberation Day, markets have largely learned how to price in the unexpected, how to price in the instability or the uncertainty from tariff policy, knowing, Dean, as you know better than anyone, you could have one announcement at 10 a.m. and a fundamentally different announcement at 2 p.m. The market has two different reactions.
Yeah, I tell you, it's funny. I didn't really expect to be navigating markets and trying to manage risk over a series of tweets or Truth Social posts. But that's where we are now. You've really got to pay attention all the time. Now, on the other hand, what we really have here is a market of high uncertainty and high volatility. For most people, including the way we invest money for our investors, we're not really trying to trade this news minute by minute, day by day. What we're really trying to do is manage the risk overall that we have in our portfolio. We've got sort of a risk target that we have for volatility and exposure to interest rates. We want to manage to that over the medium to longer term and try to generate as much cash income as we can. We think in a volatile market, that's the strategy that makes sense.
Yeah, Dean, one of the big news-making items out of our nation's capital is going to be the Republican Congress's effort at its budget reconciliation bill. The president likes to call it his so-called big, beautiful bill. What are your thoughts on passage of that, and what does that mean from where you're positioned into the markets, Dean?
Yeah, it's not a great bill by any stretch of the imagination. It's almost a case of, is it going to be worse if it passes or if it doesn't pass? I mean, I'm not sure what Plan B is, but the deficits that this bill will incur over the next 5-10 years are pretty astonishing. And what it's causing, I mean, we've continued to see now the yield curve steepen. We're continuing to see interest rates push higher at the medium and long term. There's this sense that 5% is some kind of a cap on the 30-year and maybe 4.5 on the 10. We don't think that's the case at all. We think interest rates could go quite a bit higher from here if the worst of this budget bill goes into passage. So you've got the tariff uncertainty, you've got this budget uncertainty. It's really difficult to try to kind of pick tops and bottoms here. We don't think it's a smart thing to do.
Dean, does it surprise you that after all the conversations we had on the campaign trail, the efforts of the so-called Department of Government Efficiency to cut wasteful spending, that once again we are talking about the state of our debt and deficit in such a dire circumstance, specifically related to this budget reconciliation bill?
Yeah, there are very, very few budget hawks left in D.C. You can probably count them on one hand. Both parties are the party of big spending these days, and there's just no real sense of discipline or looking for the long term right now. So, people are starting to think about U.S. Treasury bonds as risky assets, not risk-free assets, and I think that's going to persist. You're seeing this also in the currency. Traditionally, the currency will appreciate as interest rates go higher. That's not happening here. The dollar is not following, not tracking with a higher medium and long-term interest rates, and that's concerning. So between the budget problems, the deficit, the tariff and trade problems, you're going to see people start to rethink their relationship with the U.S. dollar and the U.S. Treasury market. And this is a monumental change. This is not just sort of market noise. This is some real fundamental change happening in the world economic order here. And I don't think you say the market is coming to grips with it. I don't think we've completely digested what's happening here by a long shot.
Dean, I got less than 30 seconds with you. Your expectations or what you're looking for the May unemployment report, and where does that leave the Fed? Where do we go from here?
Yeah, I mean, unemployment has been kind of hanging in there. I mean, hiring is curbing off in some areas, but it still remains strong in others. As far as the Fed goes, we continue to see them stay on the sidelines. Jay Powell has told us his hands are in his pockets. He's not doing anything until he sees the whites of their eyes, so to speak, in terms of real change in the economy. We think that persists well into Q3 and maybe Q4 or even into 2026.
We will see what happens, but in the meantime, you are an expert guest to help us all get a little bit smarter about it. I hope you'll rejoin the show soon. Dean Smith, Chief Strategist at Folio Beyond. Dean, thank you. Have a good morning.